Okay, good morning and good afternoon, everyone. Again, my name is Javeen Tay from SS&C Intralinks, and we're very excited to welcome you to the Asia Pacific edition of the Nature of Dealmaking webinar series, hosted by SS&C Intralinks, where we dive into the trends and opportunities for M&A, dealmaking, and private equity. Before we start, we would like to share some housekeeping matters with you. This platform is actually customizable according to your preference. You will see a media box in the middle of your screen, and you will be able to adjust the screen to a size that you are comfortable with. So you can also see that there is a box on the left side of your screen, and it's the 2025 APAC Dealmakers Sentiment Report, which is available for download if you click through it. And at the end of the session, we will have some time for Q&A, so feel free to put your questions into the box at the bottom of the screen at any time during the panel session. All questions posed are confidential, and we will get to your questions in the order which they are received. And we have a very exciting panel of experts today, and I would like to introduce you to the moderator of the webinar today, Mr. Mischa Mulligan, Country Sales Lead for SS&C Intralinks Japan. Over to you, Mischa.
All right. Once again, welcome to our annual webinar series, The Future of Deal Making. Hope you're all hanging out to your seats. In APAC, I believe we're in season 3 now. This is our 3rd installment. So who knows, maybe a few more of these and we'll have our own Netflix series or something. Yeah. But thank you all again for joining us. And my name, once again, is Mischa Mulligan, Director at Intralinks and Country Lead for our team in Japan. I will be your host moderator. Surprise, surprise. And I'm very excited because we have an amazing group of speakers on the panel today who will be sharing their thoughts and advice on the M&A market as we navigate 2025. Before we get started, I do want to take a moment and properly introduce our panelists, if I may. Our first guest is Tim Miles, founder and principal of Miles Advisory, based out of the ANZ region. Tim has worked in corporate finance since 1997. And in 2002, founded Miles Advisory Partners, which specializes in the mid-market. Since the firm's founding, he's led more than 100 successful private public transactions. So good to have you with us, Tim. Thanks for coming.
Thank
you. Next up, we have Yeung Tsai, who is a managing director within the M&A investment banking team at Citi. Yeung is based in Hong Kong and specializes in public M&A with a focus on Greater China, and is also responsible for the sell-side M&A business across APAC. Thanks for joining us, Yeung.
Thank you so much.
All right. And last but not least, we have Akshay Pradeep, Executive Director and Solution Partner at Standard Chartered Bank. Akshay is based in Singapore, covering the Southeast Asian markets, has 14 years of M&A experience across various sectors, and specializes in complex cross-border transactions. Good to have you with us, Akshay.
Thanks for having me.
All right. So there you have it, folks. For all the viewers, you're in good hands. We have a very accomplished group of advisors who cover different core regions, as you heard, giving us a relatively balanced representation of APAC overall. So without further ado, I'd like to start talking and pass the mic over to our experts. Let's start with a sort of an easy warm-up question. And I always like to start and end on a positive note. So in that spirit, what excites you all most in 2025? We're already a month and a half in, but are there particular sectors or regions where you see the greatest opportunities emerging? Yeung, let's start with you. What are you seeing in Greater China?
Excellent. Thanks again for inviting me. So three trends that I wanted to share with everyone on this panel. Number one is Japan M&A. There has been a pro-growth, pro-business agenda in Japan. Reforms from the METI and the Tokyo Stock Exchange has been a catalyst, for deal making in the region. Especially there's a desire for Japanese listed to increase valuation. For example, below 1 times price to book companies, they have to issue and disclose plans to improve the capital efficiency. And just a fun fact, if you look at all the Tokyo Stock Exchange listed company, about half of these companies are below book, right? And then boards are more accountable to maximize shareholders' value, and so that's why you see a lot of, disposal, spin-offs, an acquisition. So that makes Japan the perfect ground, if I may, for shareholder activism and unsolicited M&A. The biggest one, as we all know, is Couche-Tard's bids for 7&I. So this has been reflected in the overall M&A volume, where Japan M&A volume accounted for 20% of the region's total revenue. And in fact, a lot of clients in this region has launched both hostile and friendly takeovers on Japan listcos. And just a few weeks ago, we helped actually our Taiwan client is Media to do the first ever acquisition of a Japan listco incorporated in the US. So that's the first trend. Second trend, which I'm really excited about, is sponsor M&A. As you know, in our region, in the Greater China region, it's been quite tough for sponsors to exit. But I think this year they'll be more motivated to deliver exits. And there's a big focus on DPI. So I think this year there'll be a lot of pressure to deploy capital. And then in China, for example, a lot of our clients are also looking at assets in Southeast Asia, and they're also trying to pivot from a China-focused fund to the pan-Asia-focused fund. And then just to finish off very quickly, where I sit in Hong Kong is the Hong Kong take-private activity. So 24, we've seen a surge in take-private deals in Hong Kong, driven by this broader recalibration of corporate strategy in response to all this geopolitical tension and the soft Chinese economy. So just to get a sense, deal value in 24 is double that of 23. And we were part of the biggest take private in ESR last year, and I think this trend is going to continue. So all in all, I expect a very, very busy year ahead.
Thank you, Yeung, and thank you for that plug on Japan. Obviously, that's close to my heart, being based here. Tim, what are you seeing in the ANZ region?
First of all, thank you very much for inviting me to join you. I have to agree with Yeung. First of all, a lot of Australian M&A activity, M&A activity is cross-border, and we think Japan will be a very exciting part of that over the next 12, 24 months. One of the reasons is for the first time in 30 years, Japan's returned to economic growth. And so that's going to make an incredible difference in M&A appetite, interest rates. Interest rates have finally moved off zero. So we think that what we're going to see in cross-border transaction is a significant increase from Japan. And we've completed 2 transactions in the last 18 months or 14 months with Japanese suitors. So we've sold one to Kaihatsu and one to Sumitomo. So we're seeing a significant increase from that part of the region. But I also think that we're going to see a lot more activity from private equity. There's obviously been quite a large prevalence of continuation funds coming into the market for the star assets, to allow PE firms to continue to hold their vehicles for longer. And I think M&A firms going to have a larger role to play in what happens with continuation funds. But we're also seeing a lot of funds who want to go out and raise money, and to raise money, they've got to show that they can invest well and exit well. So I think we're going to see a lot more exits from the PE fraternity in the next wee while, particularly because a lot of their assets that they acquired prior to the pandemic, they've had to hold through the pandemic. So they've had them for a longer hold period. We're now long enough out of the pandemic that people can see an appropriate earnings trend and can find those businesses easier to understand. So I think we're going to see over the next 12 to 24 months significant uptake in exits from the PE fraternity. And from a sector point of view, I think consumer is probably the sector that will stay subdued, but that's because of consumer sentiment. And so, that sector is probably going to struggle the most, but we're seeing a lot of activity, business services, healthcare in particular.
Got it. I'm glad you mentioned private equity. I do want to kind of dig into that deeper if we have time later. Akshay, what about in Southeast Asia?
Thanks, Mischa. So I think Yeung and Tim made some very good points, which are equally applicable to the Southeast Asia region, with private equity exits being held up and likely to come to market just because of the pressure to return to LPs. I think Yeung also mentioned, cross-border China diversifying into Southeast Asia. That's a very strong trend that we're observing. A lot of Southeast Asian countries, including Malaysia and Vietnam, have been beneficiaries of that trend. Indonesia has kind of stepped up its ambitions to move from a commodity player to a commodity processor. So there's been a lot of investments from Chinese companies within that segment. I think Yeung made a very interesting point about reforms in the Japanese stock market. I get the sense that there are a lot of different regions looking at sort of that playbook to see if it can be applicable to their countries. For example, in Singapore, where I said the stock exchange performance and sort of the underwhelming performance that the stock exchange has delivered has led to some thinking about, can we replicate some of these, name and shame practices that worked so well in Japan, where you kind of force companies to lay out plans for returning capital and for, improving capital efficiency and profitability. We do see a few companies, for example, going ahead of the curve. For example, Singtel in Singapore and Keppel, they've all made very public announcements on divesting non-core assets and kind of returning capital back. And I suspect that this is an ongoing trend that a lot of other countries will kind of see how you can put pressure on the listcos to kind of improve shareholder returns, and one sort of fallout of that would likely be more M&A volumes.
Got it. All right. Well, it's great to hear, sort of all the spotlight on Japan. I think a lot of people have, thought that it's been undervalued for quite a long time. So it's good to hear that those reforms are sort of, resonating. Thank you all for sort of, building that positivity up. Given the previous few years, it's good to hear that there's a lot to look forward to in 2025. Having said that, let's turn to a theme that's likely front and center in everyone's mind. The elephant in the room, shall we say, with President Trump, back in office and his administration signaling a return to more aggressive trade policies. Uncertainty around inflation, interest rates, and geopolitical tensions is growing, especially with China. That's a lot to sort of pack or to uncover. But first off, what sort of impact will this have on financing conditions, if any, here in APAC? Tim, let's start with you.
Thanks. Look, I think the short and the long term will be quite different. Over the next, let's call it 6 weeks to 3 months, I think everybody's going to wait to see how much of the rhetoric is actually going to result in policy. A lot of it's going to be the art of the negotiation. So a lot of what he's putting forward, I don't think he believes will be his final position, but it's to assist him to negotiate to a point. So I think what we're definitely seeing at the moment is a fear about if these policies take hold, will it create inflation? Will it stop the downward pressure on interest rates, etc.? And people are pausing while they wait to see what impact that will have. But I think the general view is, in the long term, a lot of what he has to do, particularly the fact that he will be assertive in the way he tries to end some of the conflicts that we've got globally, and I think people will see that as a positive for the macro environment. So in the short term, we're definitely going to see people just being cautious, waiting to see are we going to have inflation, is particularly within the US, because the tariffs, etc., that he's introducing is highly likely to create inflationary pressure within the US. So I think there'll be a cautious pause over the next 6 weeks to 3 months. But I think in the long term, people will return quite aggressively to dealmaking.
Yeah, definitely not till we were expecting end of last year. Akshay, what about you? What are you seeing?
Yeah, no, Tim made some great points. I think just to add to that, short term, I think for sure it's going to be, I think, a stronger dollar, tighter financial conditions in most of APAC. I think that's just a reality. I think the long term view is key, and I think there's some hope that the bond market will act as sort of a sanity check on everything that President Trump is trying to do. We saw this happen in the UK before, where Liz Truss it tried to do certain fiscal moves, which the bond market reacted quite sharply, and when those costs started going up, she had to kind of back off, and in that particular instance, it resulted in a change in the government. So in some sense, there's a hope that eventually, once these tariffs really start to hit inflation, interest rates, borrowing costs go higher, President Trump would then start to kind of probably ease off, which means gives some breathing room for financing costs. The second point I'd make is I think the current uncertainties around interest rates are quite good for bespoke credit solutions. We're seeing quite an explosion in private credit solutions, which was kind of an asset class that didn't even exist maybe 20 years ago. It's now 10% of all bank credit in the US, and it kind of rivals the high yield bond market in terms of a source of financing. We're seeing definitely a lot of funds showing interest in Southeast Asia, in India especially, and that's becoming an alternative channel for financing some of these large deals.
Interesting. So private credit, definitely something we'll look at. Yeung, what about you?
Yes, I think back to just to pick up on Akshay's points, a lot of private credit activity, and especially right the US market. If you look at some auction processes, a lot of the financing came from private credit versus the typical LBO loans. But I think if we take a step back, right, and look at the impact on Trump's trade policy, etc., I think for sure it would strengthen the US dollars. But with the tariffs, it would have a broader implication on M&A, because every time you talk to a client, they understand that everything is in flux. But one thing is sure is that they need to live under the world of uncertainty, and they understand the need to be agile. So one example is so President Trump introduced this tariffs, and even though there's a 30-day delay on Mexico, we already have Taiwanese clients. They have a manufacturing base in Mexico. They're already calling us and say, hey, can I buy an asset in the US? Because it's all about onshoring now. So even though there's a lot of rhetoric, geopolitical, but I think from the corporate perspective, they are trying to play defense. And then, if you zoom in on, what does it mean as M&A practitioners, right? In terms of deal negotiation, etc. So on deal terms, for example, on buy side deals in my region, it's very hard for a Chinese buyer to be in pole position for US assets, especially under auction processes, because seller now, in addition to price, they also view regulatory risk, certainty closing as very important. So that's why on the SPA front, we spend a lot of time talking about reverse termination fees, the trigger of such fees, what are the remedies and mitigant, for example, if regulator imposes certain conditions before closing. So as a standard, from the seller's perspective, hell high water clauses will be the default position. And then last point I want to make is another consequence of this whole geopolitical environment is the elongation of timing between announcement and closing. Now, this may have an impact on financing, but the bigger risk, especially, is on public takeovers, where it makes an interloper easier to come in unless the initial buyer has secured enough voting support from the target's middle shareholders. So it's very interesting. It changes, how you negotiate deals. But again, everyone is kind of waiting and seeing how the tariffs, the policies will impact deal making.
Yeah, no, thanks for that context. And Yeung, I'm glad you brought up the sort of the deal term aspect of it, because that's kind of where I wanted to go next. So just to stay on this topic, and as a follow-up question to Akshay and Tim, how will these factors that we sort of talked about Trump's policies, the interest rate outlook, and geopolitical tensions. How will these factors influence valuations and deal term structures going forward? Actually, maybe we could start with you.
Yeah, sure. So on valuations, the one interesting phenomenon that we've observed is sort of regardless of kind of the tariff posturing, the Fed rates, the Fed rate cuts that are sort of being announced and are likely to come through, the 10-year bond yield has kind of settled into this, call it 4 to 5% bucket where it's kind of been in that zone, which just tells me that it is likely to push people to kind of accept that the risk-free rate is now, changed from what it was previously. And even if rates are going to come through, rate cuts are going to come through, the view is that the long-term interest rates are kind of going to be around that 4 to 5% mark, which probably might be a factor in bridging sort of the valuation gap between buyers and sellers. If there's now a consensus around what the new risk-free rate in the new normal is, it might help bridge valuation gaps and might help close deals. In terms of deal structuring, completely agree with Yeung. There's been a lot of focus when negotiating deals around risk mitigation, risk transfer. One product which has really caught on is the warranty and indemnity insurance, which increasingly you kind of see as standard in a lot of transactions. And while initially the focus was sort of an unknown risk, as the product becomes more sophisticated, you do see insurers selectively coming in for even known risks. So I think that instrument as a way to kind of risk mitigate, risk transfer will probably become very key in sort of the coming months. And we're also likely to see more contingent payments, earn-out kind of structures to, again, do these kind of risk transfers, value transfers in uncertain environments.
All right. Thank you very much for that. And Tim, what about your views on this?
It's interesting. I think it really does depend on the region and the sector. In Australia, we're relatively isolated from a lot of what the policies happening in the US. They don't necessarily impact Australia much, with the exception of how they will change the interest rate environment. Obviously, for cross-border, as the US dollar gets stronger, relative affordability changes for businesses within Australia, and so that will have a knock-on positive effect on deal flow. I think that will be offset a little bit by the fact that interest rates aren't going to come down quite as quickly as they were. I think the biggest thing is within a deal or a process construct, if you can create enough competitive tension, then the valuation outcome solves itself. And I think to the extent that the policies being introduced in the US lower the amount of competitive tension we can have in a process, because we don't get participants from China or other regions, that could have a bigger impact on valuation than interest rates or the like. But at the moment, we're not really seeing that. I believe that it will be a net positive.
Understood. No, thanks very much for that. It's very interesting. And I also, just being cognizant of that Q&A that's coming in, Javine, are we getting any Q&A at the moment?
Yeah, we have a couple of questions, but do you want to go on first? Then we can have the questions at the end.
Sure. I'm not seeing them in my inbox, so just FYI.
Okay.
And just kind of continue on with the discussion that we were having, and Tim, maybe I'll stick with you. We just talked about policy changes in the U.S., but are there any policy or regulatory shifts in APAC that deal makers should be, paying close attention to in the coming year? I know that in Australia there's a lot of developments happening.
Yeah, certainly. I mean, we've already talked about what's been going on in Japan, but in Australia, they've announced a tighter antitrust regulation through what it's called the ACCC in Australia, and I see that as being a real restriction on deal flow in the coming period. The changes will mean that where today roughly 20% of M&A transactions end up having to go through the ACCC, it'll probably flip to where roughly 80% of transactions will have to go through the ACCC. I don't think the approval rate will change. I think transactions will continue to get done. But I think what's going to happen is the delay between signing a transaction and completing a transaction is going to become an awful lot longer. And it hasn't really been getting a lot of press in Australia. When it first came out, I thought, well, the one knock-on benefit from that will be people rushing to get a deal done before the new legislation comes in, but that hasn't happened. What the ACCC are trying to prevent is the large conglomerates from being able to go and affect a series of small transactions that flew underneath their radar, and so that's why they're trying to see the vast majority of the transactions. And really, what they're doing is they're taking away the incentive for a challenger. So if you've got a small entrepreneur who decides, I'm going to start this business up because I know once I get it to a certain size, I've got an exit path for it. That exit path has become less certain because of the ACCC's intervention. So I don't see it as a positive move. I think it's really going to put a lot of timeline delays in transactions and a lot of uncertainty, because we'll end up in a situation where you start to think, well, this bidder may not get through an ACCC review, but this bidder definitely will. And so it's going to be very hard in competitive processes to look at like-for-like bidders, because there'll be a degree of regulatory risk that sits alongside it.
Yeah. Well, thanks for sharing that. And hopefully, you'll see more deals this year as people try to jump in before the regulation takes effect.
Fingers crossed.
Fingers crossed.
Just to add one point about regulatory changes, probably not emanating from Asia, but there's something that we call reverse CFIUS program. So what that is, it's a new initiative by the US, and the point is to restrict outbound investment from the US to namely China, Hong Kong, and I think Macau. And I think most of us have heard of CFIUS. But what reverse CFIUS is, so basically CFIUS is scrutinizing inbound M&A into US. Whereas reverse CFIUS is the other way, right? It's basically outbound investment into, let's say, China, for example, right? So it's basically the US way to have a more proactive approach to ensure that, US investments or US money do not enhance the capabilities of what they say, their competitors or China, right? And so the target sector, it's three main sector, right? Semi, quantum tech, AI. So that may have an impact on deal making in this region. For example, IPOs or the equity raising, where a lot of investors are US based. So that's the uncertainty, and that may affect deal making this year.
Absolutely. And we kind of saw those effects with Japan too, I believe, with US and Japan steel. So Akshay, did you want to add anything around regulations?
I think within the region, what I suspect would happen is that countries will identify sensitive sectors. There will be more scrutiny on deals happening in those sectors. In Singapore, there was a bill passed called the Significant Investments Review Bill, which specifically focused on, very core national security kind of sectors where deals would require enhanced approvals. A few years ago, I think it was India that specifically announced an FDI approval for deals emanating from neighboring countries, given ongoing tensions with China. So I think this will continue to be a theme where in certain geopolitically sensitive or sensitive sectors, there would be heightened scrutiny. So, for clients, I think sounding out regulators where possible ahead of, actually announcing deals and it going through that regulatory channel is probably a good idea.
Got it. And I do want to address some questions from the audience. So we do have a question about AI affecting deal making in the tech sector. So I think in the opening, in the beginning, we talked about some of the trends, opportunities that we're seeing, sector specific, region specific. When it comes to AI, what are you seeing in your respective regions, and how is this, affecting deal making across the tech sector? Actually, maybe we could stick with you.
Sure. So at least in South and Southeast Asia, I don't think there is sort of the primary AI type companies that are actually sort of leading the way in Gen AI. We're seeing more second order effects. So it's kind of the supporting infra that's required for AI. So that's data centers, digital infra, fiber. All of these are kind of areas where there is a lot of activity happening. And there's kind of a third order effect happening where these data centers are very power intensive. There's also a need to kind of shift to green energy. So renewable energy and renewable power to support kind of the energy consumption of data centers is, I think, a big theme. There's also, for example, I was reading in Malaysia where I think there's something like 50 data centers currently approved for construction. They're actually worried about the water that's used to cool the data centers essentially running out of drinking water. So there's probably on the utility side, on the infra side, to support what is the enhanced consumption coming out as a result of use of AI. I think that's likely where we will see deals in this region.
So a lot of activity in the AI sort of supply chain. Tim, Yeung, was there anything else that you wanted to add on that topic?
No, I think that's exactly right. It's not the AI businesses themselves; it's the knock-on impact of AI. So there's the infrastructure, as Akshay points out, and it's an incredibly good point. But there's also the impact on other business lines and business services. So if you're a SaaS business, for example, and your charge model was a fee per seat, as AI gets more and more prevalent and starts to reduce headcounts, that has a knock-on impact to SaaS firms' revenue. So you'll see SaaS businesses starting to try and change their charging model away from a per-seat model into a data usage or something similar. So it's having an impact across all industries, but it's not, AI itself isn't creating M&A opportunities for AI firms. It's more making sure that you're aware of the impact that AI has on a business that you're looking to acquire or sell.
Absolutely. Yeung, we do have a question specifically for you, a new question. In the context of sort of Chinese businesses on U.S. public markets, do you expect to see a material increase or reduction of IPOs or take privates?
Yeah, no, it's a very interesting question. The take private theme has been going on for a while because, as you know, there's a lot of what we call some orphan stocks, right? So US ADRs of Chinese companies. So we see more and more in that. And then those are mainly either founder-led or are P-led consortiums. So we see more and more of these M&As being executed. And then the whole rationale is that, there's a mispricing or undervalued theme. So the playbook usually is just to take private from the US exchange and then do a trade sale or VIPO it in Asia. On the IPO front, there are still a lot of US IPO activity going on. We see quite a bit of activity on the healthcare biotech sector in the US. But given the geopolitics, I think there's more and more companies are choosing to do IPOs in Hong Kong. And a quite prominent trend on the IPO is this A+H IPO, i.e. companies already traded on the A share now are looking to list on the H share. So there's a big backlog of such billion-plus deals going to pipeline.
Got it. Thanks for that. A lot going on in China. I want to get into another topic which was mentioned earlier, private equity. So, given all the things that we've, just discussed so far, ranging from geopolitics, capital costs, regulatory shifts, how have these dynamics shaped deal-making strategies in the private equity space specifically? Do we foresee a rise in secondary transactions and alternative exit strategies as firms navigate these challenges? Actually, maybe we could go to you first.
Yeah, no, I think absolutely. And I think that's really a function of the struggles that PEs have had with exits. So in 23 and 24, PE exits were sort of at decade lows, right? And, in a typical year, sort of the makeup of M&A deals is 60% corporates and 40% private equity. In the last couple of years, that's been, private equity at 20 to 30%. So they're definitely below the levels at which you would see PE deals. And I think that it's just a matter of time. And eventually, you do have solutions which kind of are interim measures. You have continuation funds, you have secondary transactions. All of these have been used. But I think it's eventually push will come to shove, and where people will try and make more transactions happen. Within sort of my patch of the world, I'd call out one market as being an outlier, which is India, where sort of last year it was the second largest IPO market in the world, something like $20 billion in public market listings. And PEs have increasingly taken that route to exit quite successfully in high-profile transactions in India. And what's also an interesting trend there is that you also have quite sizable block trades happening on the secondary stock market, which means that one issue with IPOs is that you can't exit completely and you're sort of left with a residual stake in kind of the listed company. But there's now an active secondary market for large minority stakes in publicly listed companies happening in India. So that's just one market I'd say which is an outlier.
No, it's good to hear some context from India. I know you previously actually were based out of India as well, so it's good to hear that context. Tim, how about you? What are you seeing in the private equity space?
Well, I think Akshay's point was exactly right, that their volume of exits was incredibly low for the last 2 years. But they also didn't look to exit either. So there's a very different motivation set within private equity to corporates doing a divestment of it or a carve out, or founder-led businesses exiting. With founders and corporates, a founder will exit the business when it's got to a point where he has a need for capital, and a private equity partnership will help him do that, or he or she, or they've just reached a retirement age. And so they're not being motivated by a money multiple or a return. And the same with a corporate. They'll divest something that's non-core because it'll let them focus on the core and generate better returns. With private equity, they are in the market constantly, so they know when a market's depressed and when there's a valuation multiples are down, and so they don't look to exit at that point because their sole reason for exiting is a money multiple to generate a return. So for the private equity volume of transactions to lift, that there has to be a noticeable shift in M&A activity and valuations. And I think the last quarter of last year and what we're seeing at the beginning of this year, that shift is starting to come. So that will be one of the catalysts for increased PE activity, is just seeing that the market is coming back to a point where they can achieve the returns they want to out of the exit. I think the other thing that has happened with private equity is the businesses within their portfolio have all grown strongly, but they've achieved that growth in many cases through M&A, through making acquisitions. And what that means is their equity value actually hasn't grown, because as they've made the acquisitions, they've had to put more debt to use or more equity, more capital in. Typically, it's more debt. And so as a result, they'll allow those to come, those businesses, those bolt-ons to achieve the synergies and then drive the equity value. So I think when we do see an uplift in the M&A volume from private equity firms, it's going to be from things they bought pre-pandemic rather than post-pandemic, and certainly in the near term.
Got it. It's great insights. And just for the audience, me and Tim did not coordinate wardrobes.
That's not true, Mischa. You sent me a memo, told me what to wear.
Yeung, for private equity, what do you see in Greater China?
Yeah, it's very interesting. I think it's similar story in the sense that in the past few years, it's been quite tough for sponsor to exit, mainly driven by the bid-ask in valuation. So you see a lot of continuation funds being set up. But I think this year, sponsor will be more motivated to exit, and we should see a narrowing of the valuation gap, given that the focus on DPI. And then in this region, one particular trend or anecdote to share is it's really quite striking to see, for good assets, it's still very much a seller's market where you can just drive the buyers, you can have very little to, a condensed DD period, etc., and then just move up the price. But that is only very, very few assets. The majority of ones of the smaller cell side, the trend is that number one, less and less structured processes, and even if there's processes, the timeline gets longer and longer. Bids are not that robust, or buyers are not following the prescribed time frame on the process. Now there's a slight change in tactic where we engage in different streams of, call it, bilateral process, and so it's a more fluid, less structured south side process and design. But I think this year, and then I think everyone on this call is pretty busy. We've got a lot of RFPs to sell portfolio companies. So I do think this year should be an inflection point where we see much more exits in the Greater China region.
Got it. And thank you very much for all that. I'm just keeping track of time here. We only have a few minutes left. So I want to ask one last question at the end. Very short answer. And again, I have to preface this by saying, Intralinks is a technology company. So this may sound like a slightly self-serving question, but I'm going to ask anyways. How do you all see the role of technology, particularly AI, shaping the M&A deal process and the work that you and your teams do? Yeung, let's stick with you.
Yeah, it's very interesting. I think it's just more than a trend. It's becoming more and more essential. So in my field of business banking, right, I think it will make our job even more interesting. And just let me explain, right? Because AI can help banker, on menial task or initial preparation task, like looking for the right comps, getting industry data. And so it would alleviate the burden on junior bankers, and it would free up more time for bankers to spend more time on more exciting stuff like negotiation, valuation, tactics, etc. On the diligence front, because of this whole, natural language processing tools, and just a plug for you guys, right? We see data providers, offering technology, to automate the review of the documents. So it's, you can literally in the data room ask a question, hey, what are the key terms of that contract? And that AI assistant can just pop you the answer in 2-3 seconds. So I think it's a very great tool for bankers. Yes.
Thanks for the plug. Akshay, how about you?
Yeah, no, I think Yeung covered it largely. I think possibly one tool that's I think in early stage, but what we've seen is once there's a practice, it started possibly during the pandemic times, it kind of becomes regular market standard very quickly. For example, so much of diligence and negotiations happens remotely now, and it's just taken for granted. And I think the tool of Gen AI helping you find precedents and help you kind of get to a template agreement or help you in negotiations. I think that's probably one trend which I see kind of picking up in the future.
Thank you. And Tim, what are your thoughts on this?
Well, I think the guys have covered it very well with what they've said. Probably the only addition I'd make to that is that from a bidder's perspective, doing due diligence, they can go a lot deeper into the information. So AI is allowing them to get a lot more data a lot quicker and a lot cheaper. And so, from a seller's perspective, you have to match that. You have to use the same tool to do your vendor due diligence and ask the same questions and make sure you've got the answers, because time kills all deals and you need to maintain momentum. And so if you're not well prepared, as you start to get those questions that you don't know how to answer, then it will put risk into the deal. So you also need to use AI in the prep phase of the transaction as well as the diligence phase.
Yeah, absolutely. As as more of these deals are virtual now, it does feel like it's really speeding up. So no, thanks all for that. And we are actually just on time. So while I wish we could, continue this conversation for longer, I'm afraid we'll have to end it there. So on behalf of Intralinks and everyone attending this session, I'd like to give a big thank you to our panelists. Once again, Tim, Yeung, and Akshay. Really appreciate you making time for us today. And, I, for one, enjoyed your company and valuable insights. So hopefully this will be the first of many appearances to come.
Thanks, Mischa. Thank you, everyone.
Thank you. Thank you.
Lastly, thank you to those in the audience for attending the session. I hope you enjoyed it. And please keep an eye out for our Dealmakers sentiment report, which will be released in the coming month. Over to you, Jen.
Thank you, Akshay, Tim, and Yeung, for sharing your valuable insights. I'm sure there are many takeaways from today's session that our audience found useful. And we hope you've enjoyed the Asia Pacific edition of the Future of Dealmaking webinar series. And if you would like to hear more insights from the other parts of the world, we do have more sessions available on our SS&C Intralinks page. So just now, Mischa mentioned the 2025 Dealmaker Sentiment Report is also available for download on the left side of the screen. And a recording of this webinar will also be made available in the coming days, and it will be sent to the email address that you have used to register for this webinar. So stay tuned. And on behalf of SS&C Intralinks, thank you for attending the webinar, and we wish you a pleasant day ahead.